Bill. I would extend this question to basically all of FANG at this point. How would you categorize them?
Well, it's a wonderful time to talk about this, and we've been talking a lot in the office about where we are in cycles and history, and you always prefer to buy a wonderful company that you have confidence will grow over the next 20 years and do so when it's deeply out of favor for one reason or another. They stumble or something goes against them in the world, and then their stock cheapens up dramatically, giving you an entry point. You know, it's what Charlie Munger did for Warren Buffett. It got him thinking about, hey, it's better to own a wonderful company at a reasonable price than it is to try to buy the kind of Ben Graham deep value stuff that Warren was trained on at Columbia.
Absolutely. And we've seen how well that's paid off. So for you, that approach can apply to any quality stock. And a name like Apple, you'd say, you know, basically anytime it sells off, if you think it's quality, you should be a buyer. So the reason why we ask the question is a lot of the rest of the investment world does this style type investing. They're either value investors or they're growth investors. A lot of even the retail public, they're like, I don't want value, or some of them do want value stocks, maybe they want a dividend. Others say, no, I want the growth names. I want to see the performance that I saw the past decade. And I guess the point is, has a name like Apple matured beyond that point? Has the rest of FANG matured beyond that point? Or have they become less good stewards of sort of growth capital? And, are they changing their stripes?
Well, I never want to argue with the master, but we know that the companies that reach the largest capitalization and have pretty universal popularity among analysts are unlikely to offer above average returns over the following 10 years. We did a study recently. We looked at the 10 largest market cap companies at the end of each decade for the last 5 decades. And the prior 4 decades, those 10 companies underperformed the index, the S&P, every single time. And 2 of those 4 decades, you lost money absolutely. So I've missed Apple 4 or 5 times over the last 15 years. But Kelly, go back to coming off the financial crisis and the bottom of the bull market in 2009. Most of what we did was buying the Starbucks, the Home Depots, the Cabela's. We were buying growth stocks at 10 times earnings, which is hog heaven for a value guy like a firm like us to be able to buy. So if you look and you say, well, Apple was trading at, I don't know, let's say it was trading at 22 times earnings when it bottomed recently. That for a mature growth company, that's not a huge bargain. And it probably shouldn't be at a huge bargain because of what a wonderful company it is. However, if you want to make above average returns, you'd have to buy that below 20. Now let's pivot to Amazon that corrected, and it corrected all the way down to 60 times earnings. Now, AWS is a wonderful business, but I'd rather have Target or Walmart than have their retail delivery business. I think that is very difficult, and I can't imagine in the long run that company maintaining a 60 multiple.